Insights for the informed investor.
Hello and welcome to my channel. Today we are dealing with a topic that can trigger fear and hope in equal measure: recessions. When we think of a recession, images of economic downturn, rising unemployment, and falling stock markets come to mind. But what if I told you that recessions can also be a golden opportunity to achieve financial freedom? In this video, you'll learn how some of the world's most successful investors, such as Benjamin Graham and Warren Buffett, have used recessions as an opportunity to make great investments. We will take a close look at what a recession is and what stages it goes through. We'll look at the impact of a recession on businesses and the wider economy, consider the psychological aspects that cause people to fear recessions, and explain how you can overcome this fear. Finally, we'll explore Graham and Buffett's investment strategies during recessions in detail and show you how to apply this wisdom to your own investments. Let's dive right in. Chapter 1. What is a recession? Definition and general characteristics of a recession. A recession is a phase in the economic cycle characterized by a significant decline in economic activity. This decline is usually manifested by a fall in gross domestic product, GDP, over 2 consecutive quarters. However, the definition of a recession goes far beyond this technical definition. A recession affects society as a whole, from unemployment to falling wages and salaries to a deterioration in corporate profits and business prospects. The 4 phases of the economic cycle. To better understand the nature of a recession, it is important to look at the entire economic cycle. 1. Expansion. In the expansion phase, the economy is growing. This is the phase in which markets are flourishing, companies are expanding, and consumers are willing to spend money. Companies hire more staff, production capacity is increased, and consumer and business confidence in the economic future is strong. This phase can last for years, but it also carries the risk of markets overheating. If demand exceeds supply, this can lead to inflation, which could ultimately herald the end of the expansion. Second boom or boom. When the economy reaches its maximum capacity, we speak of a boom or a boom. In this phase, there is often excessive confidence in the markets. Asset prices, especially real estate and shares, can rise sharply. This often leads to speculative bubbles as investors are willing to pay high prices for assets in the hope that these prices will continue to rise. Inflation can become a serious problem during this phase, and central banks may be forced to raise interest rates to cool the economy. Third recession. The economic boom is often followed by a recession, the phase of economic downturn. In this phase, economic growth and demand slow down considerably. Companies begin to reduce their investments, cut back on production and staff, and consumer spending declines. A particularly strong feature of this phase is rising unemployment, which in turn further weakens consumption. Companies that expanded excessively during the boom may have great difficulty covering their costs during this phase. In many cases, this leads to insolvencies and a decline in the stock markets. Various triggers of recessions. Recessions can be triggered by various factors. One common trigger is a financial crisis, such as the one we experienced in 2008. At that time, the collapse of the U.S. real estate market and the associated financial instruments led to a global recession. Geopolitical tensions, drastic changes in interest rate policy, a sudden rise in commodity prices, or external shocks, such as pandemics, can also trigger a recession. Signs and initial reactions. The first signs of a recession can be subtle changes in consumer behavior, such as a decline in consumer spending and confidence. Companies may start to revise their forecasts downwards and delay investments. Financial markets often react early to these signs, leading to falling share prices. As these developments intensify, this can lead to a downward spiral in which pessimistic expectations exacerbate the economic reality. The role of central banks. Central banks play a decisive role in responding to an impending or existing recession. By lowering interest rates, they try to facilitate access to credit and stimulate investment and consumption. In severe cases, central banks may also take unconventional measures, such as buying government and corporate bonds, to to stabilize the markets, a policy known as quantitative easing. Fourth, recovery. After the low point of the recession, the recovery begins, a phase in which the economy gradually starts to grow again. Companies start investing and hiring again, consumer spending increases and confidence returns. Stock markets often rally strongly during this phase as investors begin to move back into riskier assets. This phase can start slowly, but once confidence returns, growth accelerates, eventually leading to a new phase of expansion. Historical examples of recessions. To better understand the impact of recessions, let's take a look at some of the most significant recessions in history. The Great Depression of the 1930s, which began in the US and spread around the world, led to massive economic collapses and unprecedented unemployment. The global financial crisis of 2008 was another major recession, triggered by the collapse of the real estate market and complex financial instruments. This recession led to an intensive review of the financial markets and regulatory reforms to prevent similar crises in the future. Why are recessions inevitable? Recessions are a natural part of the economic cycle. While periods of expansion are characterized by innovation and rising demand, excesses and imbalances in the economy inevitably lead to a point where a correction becomes necessary. This correction can be painful, eliminating inefficiencies and ridding the market of excess capital. In the long term, however, recessions ensure that the economy can continue to develop healthily. They eliminate overvalued assets, reduce excessive debt, and create room for new, more efficient market participants. Chapter 2. Effects of a recession on companies and the economy. Negative impact on companies. Recessions pose enormous challenges for companies. Those operating in highly cyclical sectors or with a weak balance sheet structure are particularly affected. During a recession, demand for goods and services falls, which leads to a drastic drop in sales. Companies that rely on high margins come under pressure, which often leads to cost-cutting measures such as redundancies, site closures, or a reduction in investments. However, these cost-cutting measures can affect a company's long-term growth prospects. Special challenges for small and medium-sized enterprises, SMEs. Small and medium-sized enterprises, SMEs, are particularly vulnerable to the effects of a recession. Compared to large corporations, they often have fewer financial reserves and less access to credit. During a recession, it could become more difficult for SMEs to cover their operating costs or make new investments in order to remain competitive. Many SMEs are also more reliant on local markets, which can be hit particularly hard in a recession. This is why we often see a higher insolvency rate among SMEs during economic downturns. Financial stress and credit markets. One of the most serious effects of a recession on companies is restricted access to capital. In uncertain times, banks and other lenders often pull back and tighten their lending terms. This means that companies may not be able to obtain necessary credit to maintain liquidity or invest in growth. In extreme cases, this can lead to payment defaults and insolvencies. Even companies with solid business models can get into difficulties if they do not have access to sufficient liquidity. Positive effects, market shakeout, and increased efficiency. Although recessions are often painful, they can also have positive effects in the long term. They force companies to rethink their business models, eliminate inefficient processes, and focus on their core competencies. Weak and inefficient companies are forced out of the market, making room for stronger and more innovative players. In this respect, a recession acts as a filter, clearing the market of companies that could continue to exist under normal circumstances but have no long-term viability. Recessions as catalysts for innovation. History shows that recessions often act as catalysts for innovation and structural change in the economy. Companies that are forced to rethink their strategies may find new ways to improve their products and services, open up new markets, or optimize their cost structure. This willingness to innovate not only leads to companies emerging stronger from the crisis, but it can also lead to significant breakthroughs that transform the entire industry. Examples of this include technological innovations that were developed during economic downturns and subsequently brought to market maturity. If you've enjoyed the video so far, don't forget to like it, subscribe to my channel and activate the bell to give the channel added value and support my channel for free. Chapter 3. Why are people afraid of recessions? Psychological factors. The fear of a recession is deeply rooted in human psychology. Uncertainty is a key factor. When people feel that they are losing control of their financial future, this can cause severe stress. This fear is exacerbated by the phenomenon of loss aversion. People feel the pain of a loss more strongly than the joy of an equivalent gain. In times of economic uncertainty, people therefore tend to focus more on the negative aspects, which further increases their anxiety. The influence of social dynamics and groupthink. Groupthink plays a major role in reinforcing fears of recession. In times of economic uncertainty, people tend to take their cue from the actions and opinions of others. When the majority are pessimistic and reduce their spending or sell assets, the pressure increases to make conservative decisions as well. This collective panic can cause negative economic trends to intensify, even if the underlying fundamentals do not justify it. Media coverage and its impact. The role of the media in the perception of recessions cannot be underestimated. By constantly reporting on economic problems and negative forecasts, the media often reinforce people's fears. Negative headlines and alarmist reports sell better, which means that crises are often over-dramatized. This can lead to a vicious circle in which reporting increases panic and further destabilizes the economic situation. Economic uncertainty and job losses. A major reason for fear of recessions is uncertainty about one's economic security, especially one's job. In a recession, unemployment tends to rise, leading to financial difficulties for those affected and their families. The prospect of losing their income or seeing their purchasing power significantly reduced is extremely stressful for many people. This uncertainty leads people to drastically cut back on their spending, which can further worsen the economic situation. Social and cultural impact. In many cultures, economic success is seen as a central component of social status and personal identity. A recession that threatens or destroys this success can therefore trigger deep fears that go beyond purely financial concerns. The fear of social decline and loss of social standing can be just as strong as the fear of financial ruin. These fears are often reinforced by social expectations and norms that see financial success as a measure of personal and family success. Lack of financial education and its effects. A lack of financial education is another major factor contributing to fear of recessions. Many people do not understand the basic principles of the financial markets or the economy, and are therefore unable to make informed decisions. This lack of knowledge often leads to irrational fears and behaviors, such as panic selling stocks at rock-bottom prices or avoiding investments altogether during uncertain times. Financial education can help alleviate these fears by enabling people to recognize the opportunities that recessions present. The lack of financial resilience. Another cause of fear of recessions is the lack of financial resilience. Many households do not have sufficient reserves to withstand a sudden loss of income or unexpected expenses. This financial fragility makes them particularly vulnerable to the effects of a recession. Without a financial safety net, even small economic losses can lead to major problems, which significantly increases the fear of a recession. Chapter 4. The Strategy of Benjamin Graham and Warren Buffett in Recessions. Benjamin Graham's Principles of Value Investing. Benjamin Graham, known as the father of value investing, developed a strategy that aims to invest in undervalued stocks, that is, stocks whose market price is significantly below the intrinsic value of the company. This discrepancy provides a margin of safety that protects investors from losses if market conditions continue to deteriorate. Graham's approach is particularly valuable during recessions, when markets often overreact and prices fall sharply. Graham's book, The Intelligent Investor, is considered the Bible of value investing and emphasizes the importance of thorough fundamental analysis and patience when investing. The margin of safety and its importance in recessions. The concept of the margin of safety is a central part of Graham's investment philosophy. It describes the difference between the intrinsic value of a share and its current market price. This margin of safety protects investors from errors in analysis or unforeseen market conditions. During a recession, markets tend to be overly pessimistic, which means that the margin of safety is often greater. This offers patient and well-informed investors the opportunity to buy high-quality companies at a fraction of their true value. Warren Buffett's adoption and adaptation of Graham's teachings. Warren Buffett, one of the world's most successful investors, was a student of Benjamin Graham and applied and developed his principles in his own investment strategy. While Graham focused primarily on quantitative analysis, Buffett placed more emphasis on the quality of the company and its management. Buffett looks for companies with strong competitive advantages, which he calls economic moats, that enable the company to generate high returns over a long period of time. Buffett's long-term approach in recessions. Buffett's famous quote, "Be fearful when others are greedy and be greedy when others are fearful," perfectly summarizes his philosophy on recessions. While most investors panic and sell during a recession, Buffett sees this as the best time to buy. He believes in buying stocks when they are undervalued due to short-term market disruption and holding them for the long term until the markets recover and the company reaches its true value. Practical examples of Buffett's strategies. A notable example of Buffett's strategy during a recession is his investment in American Express in the 1960s. The company was embroiled in a financial scandal, and its shares fell dramatically. However, Buffett recognized the long-term value of the company and invested heavily. Years later, this investment paid off as confidence in American Express was restored and share prices soared. This example shows how important it is to remain calm in times of uncertainty and to recognize the intrinsic value of a company. Buffett's focus on consumer monopolies. Another important aspect of Buffett's strategy is his focus on consumer monopolies, companies that have such strong brands or market positions that they can maintain or increase their prices even in difficult times. These companies are less vulnerable to economic downturns and therefore provide an additional margin of safety for investors. Examples include his investments in companies such as Coca-Cola and Kraft Heinz. Lessons from the strategies of Graham and Buffett. The main lessons we can learn from Graham and Buffett's strategies are patience, discipline, and the ability to remain calm in times of market panic. They show us that a recession, although fraught with risk, also offers great opportunities if you are able to recognize undervalued stocks and take a long-term view. These principles are timeless and can help you to invest successfully in any market phase. Chapter 5. Practical tips for investors during a recession. Diversify your portfolio. One of the most important strategies to protect yourself during a recession is diversification. By spreading your portfolio across different asset classes and industries, you reduce the risk that a single economic downturn will severely impact your overall wealth. In a recession, different industries tend to be affected differently, so broad diversification is key. Liquidity management. In times of economic uncertainty, liquidity is crucial. It is important to have enough cash or liquid assets available to cover short-term needs while retaining the flexibility to take advantage of market opportunities. A common mistake made by investors is to have too little liquidity during a recession, forcing them to sell assets on unfavorable terms. Investing in high-quality companies. Recessions provide an excellent opportunity to buy high-quality companies that are temporarily undervalued. These companies often have strong balance sheets, stable cash flows, and competitive advantages that help them survive a recession and emerge stronger afterwards. However, it is important to conduct a thorough fundamental analysis to ensure that the company not only appears cheap in the short term, but is also value accretive in the long term. Avoid panic selling. A common mistake made by investors in a recession is panic selling. When markets fall sharply, the temptation is great to realize losses to avoid further damage. However, historical data shows that those who keep their nerve and hold their positions usually do better once the markets recover. An important lesson is not to react to short-term market movements, but to focus on the long-term fundamentals, patience, and a long-term perspective. Long-term thinking is essential in a recession. Recessions are temporary and the economy will recover. Investors who are patient and keep their long-term goals in mind will find that they are able to weather the recession and even emerge stronger. It is important to keep a close eye on market developments, but not to be distracted by short-term fluctuations. Summary. To summarize, while recessions are a time of uncertainty and economic downturn, they are also a period when smart investors can find great opportunities. The strategies of Benjamin Graham and Warren Buffett show us that thorough analysis, discipline, and patience are crucial to investing successfully in uncertain times. Instead of being driven by fear and panic, you should learn to recognize the opportunities that present themselves in a recession and take a long-term perspective. Remember that every crisis is also an opportunity, and use this wisdom to secure your financial future. If you enjoyed this video and want to learn more about investment strategies, subscribe to my channel and activate the bell to never miss future videos. Also, feel free to leave a comment if you have any questions or want to share your own experiences. See you next time.